Welcome to Trading an Edge, the deep dive where we break down the psychology, mindset, and system of elite trading. Today, we're revealing how to fundamentally transform your approach, moving you from being a gambler to becoming the house itself. You see, trading isn't about luck or hitting every single trade. No, it's about building a robust statistical edge. And then, well, possessing the unwavering discipline to let it play out over hundreds, even thousands of decisions. This isn't some game of chance. It's actually a rigorous science of probability.
Precisely. And every trade, for the professional, it's just a data point, a single data point within an overarching probabilistic framework. Our analysis time and time again shows that expectancy, coupled with disciplined risk management and, frankly, an unshakable mindset, those are the true architects of your edge.
Right.
Without these, even a string of winning trades can be, well, an illusion. It can lead to eventual downfall. But with them, individual losses, they simply do not matter because your system's long-term advantage is secure. The elite trader focuses relentlessly on the integrity of their system, not on isolated outcomes.
Okay, so our mission today then is to equip you with the mathematical and psychological insights you need to profoundly elevate your trading, shifting you from merely reacting to all that market noise to proactively structuring your own success. Get ready to maybe dismantle some long-held beliefs and rethink how you approach every single trade. To truly understand this, we need to internalize this metaphor. What does it truly mean for a trader to be the house?
Yeah, that's a great starting point. When you observe a casino, you realize they never know the outcome of any single spin of the roulette wheel or, the next hand of blackjack. They don't need to know.
They don't need to.
What they exploit is the law of large numbers. It's simple math, really. Over an immense number of trials, their small, consistent positive expectancy ensures long-term profitability. That's the key. They operate with strict rules, completely devoid of emotion, even when facing a losing streak at a particular table. This isn't about clairvoyance. It's just about statistical certainty over volume.
Okay, so for us as traders then, it's not about trying to predict the unpredictable next tick, which, let's be honest, is essentially random, but rather designing our own probabilistic game where the odds are subtly, consistently in our favor over the long haul. How do we even begin to construct that kind of advantage? That seems like the core question.
Exactly. Attempting to predict individual market movements, well, it's a futile exercise, often favored by those with more of a gambling mentality. The professional trader, instead, dedicates their energy to developing and rigorously applying a strategy, one with a demonstrable statistical edge. And this is where proper risk management becomes absolutely paramount.
Great.
It ensures you can participate in enough market games, so to speak, for that inherent edge to actually materialize and compound over time. It lets you weather any short-term variance.
I want you to truly visualize this. Think of yourself as the casino, okay? Not the fleeting gambler. The gambler is emotionally driven, right? Chasing quick wins, fearing losses, letting market swings dictate their actions. The house, however, operates with a cold, clear logic. It doesn't react emotionally, not at all. It leverages probabilities, implements strict risk controls, and relies purely on its mathematical advantage to ensure long-term profit. Your carefully constructed system is your casino, and each trade is merely a chip placed according to your predefined rules. So, if we're building our own probabilistic casino, where do we start with the foundational mathematics? What's step one?
We begin with the concept of expectancy. Now, while most of you listening are probably familiar with the term, the real power of expectancy lies not just in its calculation, but in its accurate measurement and the unwavering trust you place in it.
Okay, let's cut right to the core math then, the math that underpins everything. Why is truly understanding and applying expectancy absolutely non-negotiable for a serious trader? And importantly, what's the common pitfall even experienced traders seem to fall into with it?
Expectancy is, well, it's the fundamental formula. It tells you, on average, how much you can expect to make or lose per trade. But critically, that's over a statistically significant series of trades. It's calculated as your win rate X, your average win per trade, your loss rate X, your average loss per trade. Pretty straightforward.
Okay.
The common pitfall, though, which research consistently highlights, isn't necessarily ignorance of the formula itself. It's the failure to accurately track these metrics over a large enough sample size. That's huge. Or worse, the emotional abandonment of a perfectly good system when it experiences a statistically normal drawdown.
Ah, yes. Pulling the plug too early.
Exactly.
Can you walk us through a specific, tangible example just to see how this plays out in real numbers and really emphasize the why behind its power?
Certainly. Let's imagine a system. Say it has a 50% win rate, which sounds average, right?
Yeah.
But crucially, it operates with a 2.1 risk-reward ratio. This means if you risked, say, $100 per trade, your average win is $200 and your average loss is $100. Simple enough. Now let's project this over maybe 100 trades. Statistically, you'd expect to win 50 trades, yielding a total of $10,000 in profits. And you'd expect to lose 50 trades, totaling $5,000 in losses.
Right, 50 wins, 50 losses.
Correct. So your net profit would be $5,000. This translates to an expectancy of $50 per trade, $5,000 divided by 100 trades. The critical insight here is that while half your trades are losses, your system still generates a substantial profit. Why? Because of that 2.1 asymmetry. The power isn't in individual wins, it's in the consistent positive edge that compounds over volume.
That example really vividly illustrates why so many traders struggle, doesn't it? They either ignore this basic math entirely, maybe chasing those quick wins, or they allow small losses, perfectly normal losses, to trigger impulsive, system-derailing decisions. They're essentially playing a game without truly knowing if the game itself is even winnable for them over time.
Exactly right. So many traders fail by focusing on the short-term outcome of each spin, rather than trusting the long-term, statistically validated edge of their own system. And that's a profound psychological hurdle to overcome.
Okay, step one, calculate expectancy. Got it. So, once we've rigorously calculated our system's expectancy, how do we actually structure our individual trades to consistently apply it? Are we looking for fixed risk-reward ratios, or should we be more dynamic right from the outset?
That's the next logical step for any trader, really, but especially for those building that foundational discipline. A fixed risk-reward system where you consistently aim for the same ratio, say 2.1 or 3.1, is paramount.
Okay.
It truly is.
Why fixed initially?
Well, research into trader psychology consistently shows that this consistency instills crucial discipline. It teaches you to adhere strictly to your plan, which is harder than it sounds. It helps you resist that powerful urge to move stop losses or take profits too early. And it helps you effectively manage the powerful emotions that inevitably arise during trading. It basically builds the neural pathways for good habits.
Okay, that makes sense. Building the muscle memory first. And then for more experienced traders, those who perhaps already have those foundational habits deeply ingrained, how might their approach to risk-reward evolve?
Good question. More advanced traders might graduate to dynamic systems. You often see these employed in, trend-following strategies. These systems adapt to prevailing market conditions, allowing profits to run significantly further in really favorable trends while still cutting losses short, which is always key.
So potentially higher returns.
Potentially, yes. They offer higher potential returns, but, and this is important, they demand greater experience. They require a more nuanced understanding of market behavior and the flexibility to adjust, but always within defined parameters. The core principle, however, remains exactly the same. Always ensure your potential reward significantly outweighs your defined risk. The key is mastering the foundational fixed systems first. Then you can explore more complex dynamic approaches as your skill and, crucially, your emotion control develop.
Okay, this brings us to step 3, and this is where it gets really interesting and, frankly, completely non-negotiable. If expectancy is our roadmap, then risk management. That's the robust, armored vehicle ensuring we actually complete the journey, ensuring we navigate all the inevitable bumps and detours along the way.
This truly is the most critical aspect. I can't emphasize that enough. It's the unbreakable foundation. Just like the casino ensures its longevity by managing its exposure, regardless of any single table's short-term outcomes. You, as the house in your own trading, must keep your risk per trade exceptionally low.
How low are we talking?
Professional traders, and this is backed by countless studies and just empirical data, consistently risk only 1% to 2% of their capital on any single trade.
1 to 2%. That sounds small to some people.
It does. But this seemingly small percentage is actually a very carefully calibrated buffer. It allows you to weather inevitable losing streaks, which are a statistical certainty, even with a great system, without blowing up your account. And, just as importantly, without sustaining the kind of psychological damage that impairs your future decision-making.
Okay, so losing streaks, they aren't necessarily a sign your system is broken. They're more like a normal, statistically predictable part of the game, even with a strong edge, correct? So it's absolutely crucial to plan for them.
Absolutely. Analysis of literally thousands of trading strategies demonstrates this clearly. Even a system with a solid 60% win rate could realistically experience a string of, say, 7 or 8 consecutive losses over a large sample.
Wow, 8 losses in a row, even winning 60% of the time.
It happens. Now, if you're risking, let's say, 10% of your capital per trade, which some novices do, well, an 8-trade losing streak wipes out nearly 80% of your account. That's devastating, often unrecoverable, both financially and psychologically. Planning for these drawdowns is paramount. Using tools like extensive backtesting and Monte Carlo simulations allows you to understand the statistical likelihood and potential severity of such streaks for your specific system. This enables you to adjust your risk per trade, usually down, to ensure long-term survival and prosperity. It isn't about avoiding losses. It's about making them mathematically insignificant in the grand scheme.
Okay, so step 1, expectancy. Step 2, risk-reward ratio. Step 3, robust risk management per trade. We have the mathematical framework, the external safeguards. What's the biggest internal threat? What's the adversary within that can derail even the most meticulously planned system?
Yeah, the internal battle. The biggest threat is undeniably emotional trading. No question. It manifests in predictable ways. Overreacting to losses, maybe revenge trading, chasing wins with increased size because you feel hot, or believing in streaks, either good or bad, that simply don't exist beyond random variance in the short term.
The gambler's fallacy.
Precisely. This is exactly where the gambler's fallacy takes hold. That mistaken, deeply ingrained human belief that past outcomes somehow influence future independent ones. You know the example. If a roulette wheel lands on black 10 times in a row, red isn't magically due. Each spin remains an independent event with the exact same underlying probabilities.
And in trading, how does this insidious fallacy manifest itself? How does it specifically derail our well-laid probabilistic plans?
Oh, it's insidious is the right word. It manifests as perhaps increasing risk after a string of losses, hoping get back to even quickly. Big mistake. Or overtrading, feeling invincible after a few wins, taking trades outside your plan. Or, and this is critical, abandoning a perfectly sound, statistically validated strategy simply because you feel due for a win, or maybe you've lost confidence after a few losses.
Letting feelings override the stats.
Exactly. Each individual decision, each trade you place must be entirely detached from ego, detached from hope or fear or from some sense of fairness you think the market owes you. Your identity as a successful trader is not tied to the outcome of any single trade. It just isn't. It's inextricably tied to your process mastery and your statistical consistency over the long term. Trusting your edge, even when it feels uncomfortable during a drawdown, is the ultimate psychological discipline. That's step 4. Adopt that probabilistic mindset.
Okay, so this really brings us to the ultimate point, step 5. Given all this, what does it mean for our day-to-day approach? How do we practically cultivate this long-term vision? How do we consistently resist that powerful immediate pull of short-term emotional reactions?
Yeah, bringing it all together. If we connect this to the bigger picture, the day-to-day reality, means focusing maybe 100% on the process, not the outcome of any single trade. The individual outcome of trade number 47 out of 1,000, let's say, truly doesn't matter nearly as much as your overall system's integrity and your unwavering discipline in executing it according to the rules.
So zoom out. Look at the bigger picture.
Exactly. Measure your success, your progress, your P&L over hundreds or even thousands of trades, not merely a single week or month. Our research and decades of market history consistently shows that it is small, consistent gains, compounded relentlessly over time through disciplined execution. That is what builds significant, sustainable wealth in trading, not home runs.
And this commitment to process mastery, this trust in the long term, it also includes continuously refining our system, right? Staying adaptable to evolving market conditions while still trusting those core principles we've discussed.
Exactly. Step 5 isn't just blind faith. It's trust coupled with diligence. The journey of an elite trader is absolutely one of continuous learning and disciplined execution. Regular and rigorous backtesting against historical data is crucial. It helps refine your system's parameters, maybe identify new opportunities, and ultimately improve its expectancy over time. As you accumulate experience and market wisdom, you might indeed evolve to more dynamic systems, as we discussed. But they should always be grounded in statistical proof and robust risk management. It's really an ongoing cycle. Analyze, execute, review, refine. That's mastery through consistency.
Okay, let's recap. We've really unpacked how trading at its core isn't about fleeting luck. It's about building a robust statistical edge. This is achieved through, first, accurately understanding expectancy, then applying disciplined, often fixed risk-reward ratios, especially early on. Third, implementing unbreakable risk management, like that 1-2% rule. Fourth, adopting a truly probabilistic mindset, ditching the gambler's fallacy. And finally, step 5, trusting your long-term process above all else. It is, quite simply, about becoming the house, not the gambler.
Could have said it better. By consciously shifting your focus entirely to the system, detaching completely from individual trade outcomes, and mastering that internal game, that emotional discipline, you transition. You move from being at the mercy of the market's random whims
Yeah.
to actually orchestrating your own statistical advantage. You become an architect of probability in your own trading.
So here's the provocation for you listening. If you continue to gamble on each trade, allowing emotion and random chance to dictate your actions, you will unfortunately forever remain at the mercy of luck. It's just math. But if you truly understand expectancy, rigorously manage your risk, and really commit to playing the long game with unwavering discipline, you will become the house. The question for every serious trader listening right now is this: are you content being a gambler, forever subject to chance? Or are you ready to step up and become the undisputed master of your edge, trading an edge where psychology meets profitability?